Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, traders and investors. Welcome to this Wednesday, March 22nd edition of Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick. On today's show, we're going to run through some of the earnings from yesterday, including FedEx and Nike. We're going to talk to our guest at 8:35, who is Andrew Zatlin. He is the guy behind Moneyball Economics. We're going to talk about what his Vice Index has to say in March, and also about a way to invest using his overall thesis. And we're going to talk about the financials getting killed, the market on defense, and all of that great stuff. Joel, how are we doing in the S&Ps overnight / this morning?
We dipped down to 23.32 and a quarter. That is a level we haven't seen since mid-February. Had a couple lows at 33 and a half. So $7 above that pre-market low. We may see that though this morning. On the upside, haven't even went green on the screen. We went out off the board at 42 and a quarter. 41.50 is the high, so got to get green before we go any higher. Moving on to crude. Crude is trading up just slightly here. Gold and silver are in the red. Dennis, how you doing on this Wednesday morning?
Just chilling here, looking at an apparent flat market, although I challenge whether it's really flat.
Well, and why do you say that?
Because I see a lot of things in my down filter here this morning. So I think, you're seeing some things up here this morning, some of the defensive stocks, but the majority of stocks that I'm seeing trading significantly red here this morning. A lot of your financials very weak here. Citigroup's down 0.75% after a disaster yesterday. Bank of America is down another 1% here this morning. JP Morgan, Goldman Sachs trading down. Goldman Sachs is down over $1 here this morning. So if you're coming in here thinking, oh, it looks like we're flat this morning, I don't think we are. There's a lot of individual stocks that are looking weak here. So interesting market that we have. SPY is actually trading flat. The S&P futures, like you were saying, are down, 3 now, Joel?
Yeah, 3 and a quarter. But Dennis, get in there and start buying. This is a buy the dip. This is a classic just get in there and buy with reckless abandon.
Is that what you think? Maybe you're right. It's worked. How many times has it worked? Pretty much every time. But I don't know. I love my 2-day rule. You know how I love the 2-day rule. And that's why I came in a little bit short here this morning. Overnight. I wasn't buying on the dip yesterday because I often say there is usually follow through the next morning. And then, you get, 30 minutes after the open, where all the Johnny-come-latelys have now said, okay, I need out because they read the headlines last night. They got all scared, called their broker this morning, getting out here now this morning. So, I think that's why you see follow through and stuff like the financials. But, when the dust settles, around 10 o'clock, that's where I really want to see, the market start to turn. If it doesn't turn at that time, then, you start to get concerned.
All right, let's talk about the drivers. Let's talk about the catalyst here. And now you said the thing about the Washington Post. There was a Washington Post article out basically talking about a Trump aide laundered payments for a party with Moscow ties. Now, you said, I see that 21 hours ago. You said that was out the day before. So
I think the New York Times, actually, I heard was the first that was breaking that. I mean, it was Washington Post as well. Maybe there's multiple sources breaking the same stuff. But I was looking through my Twitter timeline, and they were talking about it the day before. That's why I don't think that was the actual catalyst which really kickstarted us yesterday, because I saw it in my timeline as early as when you were saying to me yesterday during the day, I went back and I was trying to find that story, and I found it. One from the New York Times 19 hours earlier. But there's multiple stories breaking about this. So obviously, I think, saying Trump was the driver yesterday probably has some merit to it. We got his approval rating there on Monday, that had fallen. Now you're starting to see, a lot of, skepticism on, whether it was a clean election or not. More things, keep popping up here, skeletons in the closet, whatever you want to call them. But, when you see the financials get murdered as much as they were yesterday, it does make me think that the market was nervous about Trump. Why? Because the financials are Trump stocks. The financials want Trump in. They want deregulation. They love him when he talks about Dodd-Frank and potentially tearing it up because that's handcuffed the financials. It's handcuffed them in a lot of different ways. I think it's, personally, I think, just tearing that up is a mistake because the reason we put Dodd-Frank in was because we had a financial crisis, and the market forgets very quickly here. But we are only 8 years removed from that, and obviously, we put on some lending restrictions. We wanted to get them out of proprietary trading. We wanted to get less risk in our banks because we almost had a complete financial collapse back in 2008. So, I personally think tearing up Dodd-Frank is maybe not the best idea, but I'll tell you, the banks want that. So when you see the banks getting murdered yesterday, it makes me think that they were nervous about Trump.
All right, we have Andrew Zatlin in the chat here, and he says, you guys are looking for a trigger for the drop. It's a waste of time. Big boys began leaving the market before Yellen raised rates, and it's a good point. Some of these financials did not make new highs off that, but I will say Jimmy A has some good points here, too, and I think it kind of sums up what we're doing. They're talking about a health care delay, tax reform delay. So basically, you don't know which, even with a Republican Congress in there, you don't know where the heck things are going. But a lot of good points there on that. But let's move on to Nike, who beat for 19 straight quarters on EPS, but missed on revenues, and they're hitting it hard.
Yeah, well, actually, Spencer, give us the results. It was actually trading flat until they came out with the sales guidance, or some sales guidance there about 2 hours later. But give us a report here, Spencer.
Q3 EPS of 68 cents versus 53 cents, so beat, like Joel mentioned. Sales 8.4 billion versus 8.47. That was in Q3. And then on the on the conference call, they said they see Q4 reported sales growth in the mid-single-digit range, and so that was the big comment.
And this was one that I saw across too. Futures orders ex currency were down 1%. And that's weaker than the 3.4% estimates. So they didn't like the fact that their futures orders were actually down 1%. And I watched when that headline broke, Nike just collapsed. The stock just went into a free fall. It was trading just slightly in the red when that headline came across. The futures orders ex currency down 1%, weaker than the 3.4% expected. Nike fell 2 straight points. So that, was really the driver on the downside there. 54.75 is where we're trading on the pre-market. We've already traded 332,000 shares, so some big volume here as well. We've taken out the 56 support here. Joel, find us some levels, Joel. Joel, you must be on mute.
I'm here. Too bad you didn't get that lunch back on the mute button, Spencer. Did you know I got a lunch from Spencer on the mute button? I said I would go a whole show without, starting to talk with the mute button on. And I made it through one show and every other show.
And you made it through 8 minutes today.
And I made it through 8 minutes today. Wow. Between 56 and 54 is kind of scary here, but let's say you had a short position on. You're looking at that February 9th low of 53.93, so call 54 the number. Coming back on the upside, boy, in order to get back into the lower end of yesterday's range, you got to rally $3. So I don't see that happening. Just if you're stuck long, maybe using your half and whole numbers to get out or trying to short. But easier to find support in this one than resistance.
Foot Locker is trading down. Was trading down a bit last night. It's offered down the pre-market at 72.90, so that's going to be a pure sympathy move. I used to say Under Armour, but Under Armour has been hit so hard here. You wonder if there's even any gas left on the downside, just on a sympathy play. But UAA, if you're looking at it this morning, it is trading in the red here as well. So typically UA and UAA will have a little bit of a sympathy move with Nike, but we know UA has already been beat up pretty hard. Lululemon sometimes will move a little bit with it. LULU, it is offered down here in the pre-market, was trading down 62.40s last night, so I wouldn't be surprised to see a little bit of pressure on that one as well. So that's just a few sympathy plays potentially with Nike. Jumping over to the other big earnings play of last night, and I messed this one up, but anyways, I was trying to trade it, but FedEx, holy cow, this was just wild off of the report. They murdered it, and then the conference call again doing the opposite effect, just rallying the hell out of it. Spencer, give us the details.
Yeah, this was a very interesting one. So they reported Q3 EPS of $2.35 versus $2.62. So they missed on that number. Adjusted sales of 15 billion versus 14.99. So that's fine. They also reaffirmed their fiscal year 17 adjusted EPS outlook. So like you mentioned, Dennis, the stock got hit and then they rallied later on. The reason for that rally, from what I'm understanding, and this is a good article this morning or last night in Bloomberg Gadfly about why they were able to rally the stock after the fact. Basically, it comes down to getting a handle on the margins on their ground delivery business, right? With regards to e-commerce, and if you remember back, the UPS missed on their holiday quarter bad, and FedEx appears to be further along the line of integrating e-commerce with their like ground delivery business, and I think that's the reason that it got the rally.
Man, what a range here, Dennis. 183.50. That's the pre-market low here. I thought you might have stuck your neck out at 185. I mean, just a massive turnaround. Is that a new all-time high for FedEx here? Let's take a look
No,
here.
I don't
No.
think it is.
Ooh,
It's slightly off it.
maybe they'll go after the 201.57. I don't think we'll get there. That was your high back in December. That's the all-time high. So keep an eye on that. Pre-market high 198.20. And just going real quickly, just going back to the sports stocks, the Nike or Under Armour, or whatever. You got to figure out who's going to win the Masters. You know, Jordan Spieth, he's like an Under Armour guy, so you might get a pop on one of those. You just gotta figure out who's going to win the Masters here. But FedEx, as I said, pre-market high 198.20.
Just a wild ride when it got down to that 183.5. It comes all the way back, talking about a 15-point rally off of the lows. So some incredible volatility. That's why I guess you got to listen to the calls, because the calls can change things. Even sentiment in the report, when they say something different on the calls, people listen to that and sometimes come back and buy the
There,
stock, and that's exactly what they did in FedEx. There was one other one from last night, Silver Wheaton. We should mention that, which is why we're finishing up the earnings here, Spencer. SLW is trading up in the pre-market. We know this usually just moves off silver prices, but when it has its earnings report, it will deviate from the price of silver. SLW earnings.
Q4 adjusted EPS 19 cents versus 16 cents. Sales of 258 million versus 244.5 million. So they beat on both those numbers. They also said that the board has recommended changing their name to Wheaton Precious Metals, if anyone cares. And they are reporting Q4 production of 7.6 million ounces of silver and about 107,000 ounces of gold.
oh, let,
And what
let's
what are your thoughts here, Mr. Joel?
That was another thing. I was talking with my buddy yesterday, and the market melting down, and just looking at some of the asset allocation, and I'm light on gold and silver, and I'm just like, man, I just don't feel like it's just such a hedge, because sometimes when there's market turmoil, yeah, gold gets a big pop, and then sometimes when the market gets socked, they treat gold stocks just like stocks. So I don't know. This one's not bad. I can't remember who was on the show that really liked this a couple weeks ago. Was that Phil Davis or somebody had this as a long-term play, and it had a real nice move all over in the pre-market high at 2090. Don't see much there. If you really go into rally mode, 2180, 2132 was your February 27th high.
Your big earnings report from this morning. Winnebago, WGO, got murdered yesterday ahead of the report. I guess nobody had this note because it's getting it all back today. Trading at 29.70 here in the pre-market. We did tick a little 100 lot up at $30.50, but that was off exchange. So it really hasn't been through 30. That's the big psychological hurdle for WGO. But
Whoa.
let's get the details from Spencer.
Q2 EPS 48 cents versus 45 cents. Sales of 370.5 versus 345 million dollars. So they beat on both those numbers, surprisingly.
This stock surprises me, period, because back in 2011, the stock got down to $6 and it looked like it was going on the death march. And I tell you, if you were betting on nobody buying Winnebagos, you were betting wrong, because on 2012 we came back and storming hard for the next 2 years. I don't see a lot of these things on the road, but I mean, maybe that's not the indicator here, because actually the stock has performed fairly well.
I really want to take one of those to a Michigan football game, but Lisa absolutely refuses to let me drive one of them. So
What, can you rent these?
you can rent them for a day. There's a great lot right off by Novi Mall. They must have 500 of these things. I can't think of General RV, and I just want to go out there and just walk around and check them out. But man, they look fun. I don't know how easy they are to drive. Uh,
Joel will be like Anchorman 2.
yeah,
Remember that
it
scene
would
from
not be a good
Anchorman 2,
idea.
Spencer? They roll out everybody.
A couple
Yeah.
Okay,
highs,
Dennis.
a couple highs at
Sorry.
30.
I was just picturing Joel driving the Winnebago, and then I thought about Anchorman 2. I don't know why.
All right, pair highs at the $30 level if we get there, 995 and 3002. If we get real exciting, there's another double top at 3035, 3040. This one's pretty thin. I don't see it ever really trade more than a million shares, and on some days it trades 150,000. So kind of thin one here.
Okay, jumping over here just to a few other stocks on the list. I want to go back to the banks for a few minutes here because it was such a debacle yesterday, and we talked about, Bank of America off the hump and it getting killed, down, and it's down another 20 cents here this morning. We talked the big guns, but you know which bank stocks really got killed yesterday? The regionals. The regionals were absolutely slaughtered. Check out the chart of Key Corp, KEY. Stock opened the day at $18.19, opening at the high of the day. The high was 18.20, so opening basically right there, and then just collapsed. And you can forget about $18. You can even forget about $17. The stock went down to 16.90 yesterday, went through the entire 17 handle. Actually, it's trading down here again in the pre-market, 16.80. Like we were saying, the financials overall are still showing some pretty good weakness here, but holy cow, Joel, this key bank, that was a disaster yesterday.
And look at that. The gains that, took 3, 4 months to accrue. Most of it knocked out in one day. We were talking about this on the pre-market show. A lot of these regional banks, got up to like a 18 to 20 forward PE. Man, they surely don't trade. Normally, they trade the 8 to 10 range. So just got a little bit ahead of itself. This one really took a hit, lost 17, but stock traded at 17 here in November and December. So I think you might get another shot at 17, but that's a big hurdle to clear in order to get back. Coming on the downside, though, man, little stopping point at 16 and a half, and then under 15 bucks. So a lot of air, and you also have a lot of air in Bank America here. This one didn't rally with the interest rate hike. Sellers stood there trying to sell on strength. I think when we talked about this on the show yesterday, instead they had to sell into weakness. Look for the mid 22 handle today, maybe 2240, 2250.
Just a question coming from the chat. What do you mean by handle? So handle is just basically the first digit. So when I say handle and we're talking about KeyBank 17 handle, I'm talking $17. So 18 is the first two digits. So we're talking the number before the decimal point. That's the handle. So, it's just trading terminology there. So it's $17 what we were talking about. When we say 17 handle, we're talking about the $17 for KeyBank. So the number before the decimal point.
And the spoos,
Jumping.
yeah, this just the spoos. Like I say, we're trading in a 2340 handle. That can be anywhere from 2340 to 2350. So that's relating to the S&Ps, and then for crude, 4760. We're actually trading down 64 cents, and that 47 handle.
Jumping, just wanted to look at the chart of RF Financial too. Just one other regional bank that got murdered yesterday. Here's a stock, a $15 stock. It lost a point yesterday. Like you're talking, there's a big moves, Joel.
You said, oh yeah, Regions Financial. Holy mackerel, 15 to 14. See some lows under 14 here, 3 or 4, like 1375 area. Let's see if we catch some support there.
Okay, here we go. Just into the ratings changes, and there was a few here of note, but nothing too crazy. Let's look at L Brands here first. It's getting downgraded here at KeyBank. It hasn't traded this morning, but the one thing I wanted to say is, if you're thinking retail, had already been beat up, and it's probably, how low can it go? Yesterday's right. They hit the retailers really hard again. Like, I mean, I look at Macy's, I look at Kohl's, I look at JWN. Those things all got murdered again yesterday. And we were talking about them the day before how they were sitting on a cliff. I guess we were right because they jumped off the cliff on a lot of these things, the Macy's, Kohl's, and the JWN. Well, all brands chart doesn't look that great either. It's sitting right there. It's very near the lows that it made after the earnings report, I believe, back in just looking at February 23rd when it got down to 47.93. Yesterday got down to 48.51. You wonder if it's going to challenge it today with the downgrade. Depends, obviously, if the market turns around or not. But, this one doesn't look that great either.
No, 47.93 has been the low of the move. What did you say the bid offers were? Were they already offering it down?
Yeah, it's down 48.80 is offered right now. So it's offered down 40 cents.
All right. I mean, one number only here to keep an eye on, and that's been the recent low of the move here. And that was at 47.93, awful close. And if you take a look at Macy's here, that took out the low of the move. Time to go. Kohl's, did that take out the low of the move? That took out the low of the move. Boy,
They all did.
again,
JWN.
Spencer, you should
I
write
mean,
an article today about the what five retail stocks are still going to be around in 5 years.
Yeah, try to figure out which ones. Well, I tell you, J.C. Penney. I don't know. We've been talking about the death march in J.C. Penney for a long time, and it keeps on surviving. It keeps on coming back, but it took out major support again yesterday. 577 was multiple lows right in the 580, 577 area. Yesterday we went all the way down to 555. So it's the same story here. Just because it's beat up doesn't mean it can't get beat up more.
And did you see the Sears news from last night?
What was the Sears news?
That they're closing stores.
Well, this tell me
Is that the news from this morning? Like, it's trading down 14% here. Is that? Sometimes it's good news.
Stores closing.
Well, listen what they said in their 10K.
Okay, what do they say?
They said from their 10K, our historical operating results indicate substantial doubt exists related to the company's ability to continue as a going concern.
Wow, that does not sound good. It's like it's still got 7.5 points.
I know.
Still 7.5 points on the bone here. There's meat on that bone still.
Why is the stock not at zero? Is my only
Real
question.
estate play. I think it's got to still just be a little bit of, but then they spun some of that off. So I don't know, Joel. Things just don't go easily to zero. I'll tell you that. When you're betting on stocks on the going bankrupt, it's always a tough bet because sometimes they get these wicked little bounces when they get down to $2 or $3. So I don't know. I've never made money on a lot of companies betting on them going bankrupt, but sometimes they do. It just takes a lot longer than you think.
What's their spinoff stock?
There was one. What was it, Spencer? Can you remember?
Brent
We're
will
throwing
know.
you under the bus on this one because I have the goldfish memory, and if Joel doesn't remember, they did spin something off there last year. I remember something getting spun off, or maybe it was the year. Years fly by here. Maybe it was the year before. Anybody in the chat knows what the Sears Holdings spin-off stock was, but they did spin something off, and I thought it was part of their real estate.
SHOS is what Brent says.
SHOS. Brent, he's always saying, "Oh, it's a Sears hometown." Is that what it was? Look at that. They're the same shirt.
Wait, SHOS. I got to see the chart of this one.
It's Brent from 9, so it looks like it came out. I'm just looking out to the monthlies here. Actually, it was 2013, so I'm really dating myself. That thing got up to $57. It's now 3.
No way.
Don't. When you're buying stuff with the Sears brand in it, it seems to not be very good. LE, that's what I was. Land's End. Rob Hood too. That's what what the one I was thinking of actually was Land's End.
Okay,
that one's done. So that got spun off in 2014. So the years are flying by. That one's done a little bit better. Again, it got up to $55. It's at 19 now, so it still hasn't been a good investment, but hasn't been that disaster of SHOS or the SHLDs. So all of these Sears spin-offs here is still not performing very well.
Yeah, man, Dennis, now you know why we don't have any retail stocks in our portfolios. I mean...
Yeah, I had Kohl's in there for a little bit, and then I just wanted out of it. And I had that nice wicked rally, thank you very much, Trump, in November and December when Kohl's got up to $59. I sold it a little bit early. I think I was selling out in the low 50s, and I was kicking myself when I got up to 59. Well, I'm pretty happy that I sold it now, and I'm pretty happy that I'm out. I know those dividends are attractive. People come back with the argument, Kohl's 5.84% dividend, Macy's 5.32% dividend, Nordstrom 3.5% dividend. Dillard's, even my Dillard's Preferred, I sold, Joel. Had that thing. I had it for years. And I'm looking at it here at 25.06, and it's still yielding 7.5% here right now. It's right at par. It's callable there, but now I start to get concerned. I look at the DDS chart. and you go out to the monthlies on DDS, it got up to 140, over $144 back in 2015. It's now $48, and you start to wonder if people don't think like long term. Maybe it's still $48, so there's no short term concern here whatsoever. But when you're buying a preferred stock, you're buying that dividend in perpetuity. So you're buying it. They're basically buying a long bond is basically what it's like on Dillard's. I don't know if I'm willing to loan money to Dillard's at 7.5% anymore long term. If it was short term, it'd be a different story. But when you're buying a preferred, it's like buying long term. I know you can sell at any time, but if all of a sudden the preferred stock traders and bond traders decide Dillard's maybe not as safe as it used to be, they could smack that thing down $3-4. So that's why I'm out on Dillard's DDT. I had it in my portfolio for the better part of a decade, paying me over 7.5%. Actually, it's paying me more than that because I bought some of it back in the financial crisis. But I'm officially out of my Dillard's preferred because I'm just that scared of the entire big box retail sector.
All right. Let's talk about some of the big guns from yesterday and comments on Apple, Dennis.
Yeah, so props to Ace here. If you're listening, I know he was sick here, so I'm not sure if he's still. I think we saw him in the chat earlier, but he made a great call on this. He was talking. He'd been talking for the last couple of weeks. He kept saying if this thing gets up to its psychological, old 1,000 level. What is the equivalent on that, Joel? Ace has tweeted out a few times there, but
142.85.
142.85. He's like, that could be some psychological resistance because after the 7-for-1 split, if you took that, that would have been a $1,000 level. And you know what? Man, look at the high. 142.80. It got within a nickel. So Ace, props to you if you're listening there. It got within a nickel of that and then turned and reversed, obviously, and then it gets collapsed. So, obviously, a lot of the market, had to do with that because everything collapsed yesterday. But it got right to that point that he was talking about. So Ace with a good call.
All right, and boy, it peeled back. Another stock that had a big range yesterday, Facebook. The BT.
Wild.
Too bad we didn't go with the old fate of the BTIG upgrade there because you could have just started selling and kept on selling. I wonder what that guy. Who's the analyst at BTIG that did that?
Rich Greenfield.
Rich Greenfield. He's got to be
victim of the market.
He's got to be scratching his head right now, man. They got it up to 142.31, and then, as you would say, Dennis, kaplooey. Down to we made a pre-market low of 137.60. I mean, this thing is a beast. Big range yesterday, and it's funny where that it went off the board at 38.51. The low from yesterday. Keeping it. Oh, we're trading right there.
We're trading below it right now.
Just a bit. I'm still keep eye on that 138.50.
That is one ugly candle, though. That's your classic red dog reversal, isn't it?
Exactly.
Yeah. That is one ugly candle, I will tell you, on Facebook. That is a big time, people buying that breakout caught big time on that one. So, that's a consideration as well. Sometimes, obviously, these stocks, when they break out, the breakouts can become fake outs there. And I mean, everything had that yesterday. And it's all because of the market. It's not any individual news here on individual companies that were affecting these charts. This was all market related. They came in selling all of the winners yesterday. It was massive profit taking across the board. That's really what it was. When you see the financials have been some of the best performers here in the last 4 months, and those got hit the hardest. And stuff like Facebook that have been running straight up. I mean, Facebook in 2017 started the year $115, got up to 142, and there was massive profit taking. Apple, same story. Started 2017 at $115, got up to over 140, and people were bucking profits. Institutional managers were coming in saying, "Look, I'm concerned here, going forward. I didn't like the reaction maybe from the financials after, the Fed hiked rates there. There's a lot of rumors on Trump stuff here going on right now. There's a lot of reasons out there to sell if you're looking for reasons. And yesterday, the market was looking for reasons.
All right. So when the money flows out of the financials and it flows out of some of these tech stocks, it has to go somewhere, right, Dennis?
Yeah, and you know what? It was flying in a little bit to the defensive names. If you look, there was a lot of names yesterday, like your utility stocks, that were actually trading significantly higher. Check out the XLU. Obviously the TLT as well as the direct beneficiary. And then XLU, the utility stocks were trading higher. You saw some of your defensive names hold up very well. I mean, at the end of the day, they started to hit almost everything. So, some individual stocks. But, if you're looking at the Southerns and the DTE, those things all closed in the green yesterday, although they did get hit in the last hour.
All right, and someone specifically was asking about AT&T in the chat. A very, I don't want to say predictable stock, but it definitely has its patterns. Someone was hanging out 42.60, 42.70 for 1, 2, 3, 4 days in a row. There were your highs. Finally, 42.51 the high yesterday, 6 cents off the open, and then selling into weakness here. Trading up 12 cents in the pre-market, 42. If that doesn't hold, I see a mound of support under 41.80 at the 41.75 level.
Jumping over here just to a couple other stocks before we get the imbalances here. I where was my list here? Oh yeah, I want to talk about TDG because this thing yesterday had a wild ride. There was actually something going on. So Citron was the one that had been dogging this for a long time, and props to them. They are right again here. I mean, everybody in the media wants to call them out when they had the one trade wrong there on the stock that got taken over there. But TD, what was the stock? I'm forgetting now. 65. Oh, Mobileye. They're the one bad trade on Mobileye. But then TDG here, it was just I was just looking at that from Republican Ro Canna. This was tweeted out by again Mark Flo Chatter. He sent yesterday. He said, "I sent a letter to the Defense Department asking for an investigation of the business practices of TransDigm Group." And he sent a copy of that letter. So you got somebody, a Republican or sending out a letter
Well,
here on TDG.
that's a member of the House Committee on Armed Services, so it's not just any Republican. It's
Yeah, there you go. And when that came out, Spencer, you can see, and that was the major news, right?
yes,
That letter.
yes, that
And
letter was the news.
that's why I should always go to you on the news because I get it all wrong. But that's why I'm the trader, but I can't speak the news. 235 down to 215, just absolutely murdered this thing. So not sure if Citron was ringing the register on that because I think they're still short it. But wow, it was a big fall yesterday for that stock.
And boy, do you have a big level. The low of the move when Mr. Left came out with this was 214.65. You backed it up the next day with a 215.01 low. The low yesterday, 14.99, and then you got a 10-cent bounce. So 215, absolutely critical here for TDG TransDigm Group. Ed Parker is asking us about Sprint. I haven't looked at this chart in a long time. Let's take a look. Man, it didn't get hit with the rest of the market as much. I'd say
Percentage wise, it did though.
no. Oh yeah, you're right.
Down
It's a
20
lower
cents
stock.
on an $8 stock.
Do they pay a dividend?
No, they don't.
They don't. Okay.
That's why they're not loved like the AT&Ts and Verizon hold up. And that's a great point you're making because people will classify Sprint in with AT&T and Verizon, but they're not really the same because AT&T and Verizon trade more like bonds. Sprint doesn't pay a dividend, so it doesn't trade like a bond. It will trade with the overall market. So that's the consideration. Even though obviously same company business, because they don't pay a dividend, you don't have that little protection of that dividend. And obviously there's a lot of bond traders, or traders that trade the income stuff that are trading Verizon, AT&T, and those traders are not present in Sprint.
Just above $8. I see some lows here. 8.13. That was your low back on March 10th. Trading down a penny in the pre-market. And another mover that I caught yesterday a little bit, and it was the old 6-day up rule. And I'm going to say it right.
6 day up. What went up for 6 days?
NVIDIA. Went up 6 out of 7
you,
days.
you said that you got it right the first time. You shouldn't have said it again.
I know. I like that psychological 110 level. Also,
Wow.
I've been waiting for it to fill the gap that it had to gap down. So I got a few off in that. We'll see.
Double top. What'd you do? Did you sell it?
I did. I bought. I think I don't have it up here. I think I got some April 107s or 108s that were pretty cheap when it was trading up at 110. So tried not to look at it yesterday. We'll see. We'll see if it can get back down. Maybe I'd like to see it get back down to 100. But look at all those up days that you had in it. And let me count the up days that you had. You had 1, 2. Then you had a small down day, 2 or 3, 3 or 4, 4 or 5, 5 or 6, 6 or 7 up days. So a little bit psychological 110 level. came
A
in at.
double top there at 110 is what I like too.
Yeah, yep.
109.61, 109.96, and a $109 stock. I'll call it a little double top there. AMD, I always like to look at as well. They do trade those two stocks together, and look at AMD the last 2 days. A perfect double top, Joel. 1450, 1449. Ooh,
Look at
that sounds a
that.
little bit scary.
And that got up to fill the gap too, and then it came back down. So, and you mentioned before, these things really trade together.
Jumping over here to the imbalances that just came out at 8:30. We do have quite a few sell imbalances here this morning. Not surprising, you see that follow through. Bank of America 634,000 shares to
Woohoo!
sell. That is significant. Citigroup 50,000 to sell. Nike 49,000 to sell off of its earnings report. That's the one's not surprising. General Electric 177,000 to sell. Ford going the other way 130,000 to buy. 51,000 to sell in Pfizer. They're all small otherwise, like for the most part. A lot of smaller sell imbalances, but they're all mostly to the sell side. So we're kind of just hanging out here on the S&P futures, trying to get direction here. The imbalances probably aren't helping the cause for a rally here this morning, though.
All right, we have an 8:35 guest coming up, huh, Spencer?
We do. We have Andrew Zatlin from Moneyball Economics, one of the more unique ways of looking at the market, and we haven't had Andrew on since I think since before, either before the election or just after the election. So I definitely want his thoughts on the market we're in right now. We'll be right back with Andrew Zatlin. Welcome back, traders and investors, to Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick. We're on the line now with Andrew Zatlin from Moneyball Economics and Moneyball Trader. Andrew, how's it going today?
It's going good. I'm just gearing up on the market, trying to catch up with what happened last night, yesterday. I heard the market went down, basic stuff.
Right, basic stuff. So you produce the Vice Index. You're the proprietor of that. I guess for our newer listeners, briefly explain what the Vice Index is.
Okay, real quickly, we know from our own personal habits, luxury spending is kind of the canary in the coal mine. When we've got money in our pockets, we start splurging. When things get a little tight, it's the first thing we pull back on, right? Those steak dinners become maybe a pizza dinner. And the problem is, how do you measure luxury spending? You can track Sotheby's sales, but that's luxury spending for the 1%. I have been able to quantify luxury spending in a way that cuts across every socioeconomic and demographic grouping in the U.S. And we're talking millions of transactions per month. And basically, it's alcohol, it's pot smoking, it's prostitution, and gambling. And believe it or not, you're talking not millions, you're talking tens of millions of transactions per month for each of those things I mentioned. And so I've been able to quantify all this spending going back 25 years on a monthly basis. Believe it or not, it actually, as a leading indicator, it predicts retail spending by a couple of months, and it's been doing it for 25 years with incredibly strong correlation. And, theoretically, it makes sense, right? You're talking about something that's relatively high dollar, to go out and gamble, to go out and have a few drinks. You're not talking about a $1, $2 event. For example, the average escort price today is about a day and a half of wages. So you're talking about something that takes a little bit of decision making. That means, hey, I actually have some significant money in my pocket, and I'm going to go spend it.
Okay, so you come out with, the Vice Index is what, every month? You come
every
out,
month.
You come out with a new
Updated
reading.
every month.
Yep. And so what did the reading for March indicate?
Very strong, actually. And now, one of the challenges you have with an index like this is when you get a major sea change in the economy. Because it's leading, it's basically saying, hey, today, this is how I feel about things for the next couple of months. And we had a major sea change back at the end of the year. I don't want to call it the Trump rally. I don't know what to call it. But at the end of the year, spending really took off. At the same time, we also had the opposite. We had gas prices really take off. And so you've had this tug of war between the two. And so the Vice Index was kind of delayed in terms of responding to that. The latest data incorporates the things that, hey, I've got less mad money in my pocket because I've got to spend it now more on electricity and gas prices. But at the same time, that hopeful sentiment that something's going to happen in terms of better wages and so forth. What happened is the latter won out. People are spending money. And in fact, one of the more interesting things, and each month I focus in on one of those four segments, prostitution or gambling. My recent one, I focused on prostitution. Hookers raised prices, and they raised it significantly. We're talking 10, 15%, and this was not a response to something like inflation. Hotel prices went up, and so they have to cover it. No, they sat back and said, this is great. Everyone has mad money. My customers have mad money. I'm going to raise my prices $50, $100, see what happens. And it worked. They were able to raise prices in an opportunistic way. There's a lot of money out there splashing around. People are spending money, and that's a big positive as we go into this year.
I want to ask you about an article that you published recently, I think in the last week, about what Google searches are telling us about consumer sentiment, and you went back and you looked at Google searches for keywords like recession and unemployment and changing jobs, and you tracked it every 7 or so months going back about 2004. Just tell us what you found there.
Okay, so just to level set everyone's understanding, we hear consumer sentiment index says this, or those consumer confidence type of indices. Those are garbage indices. They're picking up the phone and literally talking to 400 people once a month. That's meaningless. Google gives us a tool that I like to use every quarter where you can track every single search done on Google. Think about that. Every single search. And you can narrow that down. And I do. I look at just the U.S. and I skinny it down to just a few terms, things like inflation, things like job salary raises, job security, things like that, where you can really hone in on what are people actively looking for, what is really catching their interest. And what we've seen is over the past couple of years, it goes back a decade or so, and you can see the steady trend that says, look, people feel good. They feel good about their jobs. Based on what they're looking at. They feel good about their household finances based on things like they're looking at where to invest. You don't have worries about about bankruptcy or mortgage and things like this. Basically, based on millions of searches per month, Google's telling us, this great tool is telling us that the U.S. households feel pretty confident. There are a couple of cracks in that wall. There's sort of a peak in some of this employment job security data per Google search. But I mean, we're talking about very strong data, cyclically high data. So if it's got a little bit of a flattening of the curve, it's not something that I'm really worried about necessarily. We'll come back a couple months and we'll see if it's persisting or not. But overall, again, it sort of confirms what the Vice Index is saying, which is namely, there's no major headwinds right now. Nobody is looking out and saying it's time to panic, it's time to run for the hills. There is an awareness, and the Google data was really interesting. There is a very strong awareness of things in the economy. Things like recently over the past couple of months, there's been a fear that the market's entering a bubble. There's sort of a concern about things like interest rates and inflation. I like seeing that. I like seeing that uptick in interest in those kind of concerns, because it says that the U.S. household is also not blind, that every decision that they're making is more informed. And then that's what you want, right? You don't want people saying, I'm ignoring the fact that interest rates are going up and that is a problem. That is going to squeeze. It's not a one-time event. It looks like we're going to have 100 basis points of a rise over the next, few months. That's a real issue. That has a real impact on my household finances. I'm aware of that, and I'm incorporating that in my decision making, and I'm still spending. So I like what I'm seeing. I like the market pullback, for example. I think that's a very strong sign. It's long overdue. I'd like to go down another 3% and do the old BTD, buy the dip.
All right, we're on the line here with Andrew Zatlin of Moneyball Economics. Now, you don't have to answer this question if you don't want to, okay, Andrew? But how do you survey the prices of escort services?
Oh, my God. Every single time I throw that out there, that is literally the first question. Here's what we're going to do. You're going to meet me in Vegas with a brown paper bag of non-sequential $20, and I'll show you. No, believe it or not, a lot of this data is out there. Everything I do is basically figuring out where to go and get the data, and it's out there. I mean, we are, I think it's not a surprise to notice that the sex industry has always been at the forefront of every technological revolution that there's ever been, and the digital era ushered in websites where prostitution marketplaces exist. And so what I've done is I've basically applied fundamental statistical methodologies there. I track frequency. For example, there are certain websites where you can literally track the individuals who are posting availability, and you can say, okay, if you're think of it as a hotel. Whenever you look at your emails, you probably get some flyers from Marriott or whatever. And I'm not saying Marriott's an escort, but I'm saying that Marriott advertises when they have vacancies, right? Marriott, don't sue me, please, God, don't sue me. But then, they're gonna, you have availability or you don't. Marriott's going to say, you know what, I need someone to come in. I'm going to throw out a free meal or free parking. Or the opposite. Hey, you know what? I'm sorry, sir. I don't have availability. If you want to come in, you're going to have to pay a little extra. And you can track these things. And then I put some algorithms in there that quantify it and show where the ebb and flow is. I mean, a couple of years ago, if you remember in Washington when they had the impasse, as it were, I forgot what they called it, where government shut down for a couple of weeks. These escort boards that catered to the Washington, D.C. location, they were screaming for business. So it's a very real-time, immediate. And the key is when you talk about the Vice Index, what makes it so amazingly special, in addition to the fact that it cuts across every socioeconomic demographic out there, and you're talking millions of people in America, for example, smoke pot, and they do it every month. You're talking millions of people drink, millions of people gamble. This is a cash-based business. And so this isn't something where I can spend it, put it on my credit card, come back a month or two later, and that's good. This is pure cash, which means both the supplier of the service and the buyer have to have the money. And if they don't, they're going to take immediate action. If you're a service provider, you've got to pay rent. Okay, you don't get a line of credit if you're an escort. Sorry. So you've got to make sure you've got money coming in to pay rent, car, whatever your bills are. Same thing for a potential client. None of our listener audience would be a client, of course, but the same thing is they've got to have money in hand. They can't just go and say, hey, here's a check, put it on my credit card. Although, it's interesting is when Bitcoin was raging a year or so ago, there was folks were trying to explore how to use Bitcoin, all these, again, cutting edge of technology, all money's good money kind of type of an approach.
I guess you're giving a
Again,
whole.
meet me in Vegas, dude. Meet
I
me in
was going to
Vegas.
say,
$20 bills.
you're giving me a whole new meaning to the Marriott Rewards program there.
I know.
All right.
It does follow the hotel model though. It really does. The upselling, how to get a little bit of extra cash flow from doing a couple of extra mint on the pillow type of approaches.
I want to go back to in the chat. You were talking about the institutions. We're selling ahead of the Fed number. Or the Fed bumping up interest rates. I mean, what do you look at that? Do you look at charts? Are you a technical guy? I mean,
Yeah.
how did you feel? Because there are big institutional orders out there. I mean, you talk about a stock like Bank America. Didn't make a new high for the move. Got right up to that 25.80. Maybe someone had 20 million to sell at 26 or something. How do you identify institutional order flow?
Well, partly by how do you read the tea leaves, right? That's the question. So for the past few weeks, I've been showing people different kinds of data points where you can say, wow. But I look at it behaviorally. Now, I approach everything I do comes from the fact of just like human behavior. I track, for example, hiring at the company level. And so I know, is a company stepping on the gas or stepping on the brakes? Well, are they hiring more people or are they firing more people? It's just that basic. The way I came at this was a little bit more simplistic. I look at traders. Okay, if you're trading in the stock market, there's an ebb and flow. Once we get to March, we're past most of the earnings cycle. There's not a lot of news. There's not a lot of action, right? But more to the point, you're looking at a phenomenally successful quarter for any trader out there, right? You're talking about by March, it was a 7% quarter, right? A huge moment. And these guys are savvy. You start locking in your profit. You have nothing to prove. If you've made 5 to 7% and you've got a month left in the quarter, you're not going to leave your money out there. And so sure enough, if you looked at it, you saw more risk coming down the pipeline in March. You had the Janet Yellen Fed rate hike potential. You had inflation obviously starting to pick up, so some more headwinds. You had the Trump factor starting to kick in. Is Trump going to or not going to be able to put some of his programs forward? There was just this lineup of various factors coming down the pipeline that were all headwinds. And then you look at tailwinds and you got no news. There's nothing really substantial. So sure enough, if you look at the markets, the first week of March, they flattened. They stopped going up. And then you can start looking at the volume and the trading. And really what you saw was the smart money was already starting to position out. In addition to which, you had guys like me sitting there raising their hand and saying, wow, this market's way overstretched. And so you have this kind of groupthink that goes in. On the one hand, lock in my gains. Why not? On the other hand, lock in my gains because, wow, this stuff really is overstretched. I mean, there's an awareness. There's an understanding that it's way overstretched. If you simply say any potential positive out there, any potential positive out there is already priced in. And that's what I believe. I use something simple, actually, guys. My simplest chart to sort of look at what is and what isn't happening in terms of is it overbought or oversold in the market. I take jobless claims. And you want me to share this one with you in the audience?
Of course.
Go
Of
for
course.
it.
Phenomenal.
Okay, go ahead.
Okay. So jobless claims. Let's talk about that for 1 second. Every data point that you see out there that gets released from the government is a baked model of crap. It's sampled, it's surveyed, and then they spin it through some kind of statistical modeling. You come up with it. It's kind of directionally okay. Oh, and by the way, it's done monthly. Oh, and by the way, it's usually a month or two old. So you're looking at something that happened a few months ago. That is so not the case with jobless claims. Jobless claims are not baked. They're comprehensive. It looks at everyone in the country that stepped up and said, I don't have a job this week. And it's real time. So you get a real finger on the pulse of what businesses are really doing in terms of their hiring and firing. So if you take jobless claims and you take them, now a little math here, take them year over year. And you want to do it year over year because, again, it's not an absolute number you care about. You care about, does the dry cleaner relative to last year have more money, more business, and therefore needs more people than they did last year? And that's also the way, by the way, that CEOs of major public companies think, because they're measured on an annual growth basis. The market tends to measure companies not sequentially, but how did you do relative to how you did last year? That's a sign of growth. So if you take jobless claims year over year, and you look at the ebb and flow, and you take the stock market, S&P 500, year over year, you're then going to do one extra step, because remember, jobless claims going up is bad. Well, stock market going up is good. So you have to flip jobless claims. You take the inverse, so that when jobless claims now are going down, that's a bad thing. If you lay those two lines on top of each other, if you take the S&P 500 year over year, you take jobless claims year over year, but you flip it, you will find a correlation of almost 90%. Okay? They move at the same pace, in the same way. And that makes sense because the stock market is responding to the exact same signals that the jobless claims are responding to, and that's business activity. Jobless claims get it a lot faster, more high frequency, but the stock market's getting other information as well. In any case, what's interesting is, if you look at these, you will see two things happen. You'll see when the stock market is getting way ahead of jobless claims, economic fundamental indicators. Stock market's getting too hot, stock market's oversold. The only times when it is really kind of persistently different has been during QE. The second thing that's really interesting, not just that they move together in a nice little way, and then you can find in this short term, near term, every couple of months where they're oversold or overbought, what you'll find is which line blinks first. So when they do get out of sync, when they do diverge, and then they're going to reconverge, the one that blinks is the stock market. It always mean reverts to the jobless claims level. It's a simple metric, and yet you know what? It works every single time. And so if you look at it, and I put this out to my readers, I think it was a week or two ago, and I shared this chart with them and said, look, at the end of the day, the market's about 5% overvalued relative to the economic fundamentals. Now, we know that other things can come in that goose up the market, like QE. Well, there's no QE. It's the opposite now. So I said, look, it's 5% overvalued. Maybe it'll come down 3%, because there's one thing happening right now in the stock market that's kind of creating a little bit of excitement, a little positive bullishness in me, is what's happening at the corporate level with margin expansion. So on the one hand, jobless claims are saying, look, this market's 5% overvalued. It needs to come down. Well, we just had about 1.5 points shave yesterday. It'll probably edge down because, hey, this is between now and mid-April, there's really no news, right? No more earnings releases. So that would make sense for it to drift down a little bit more. Again, if you're a trader, you want to close out the quarter. You've got pension funds and everyone having to make their move in the next week to close out the quarter. So, portfolio rotation. But one thing that I'm excited about this quarter, next quarter, is margin expansion. Most companies hunkered down last year. They trimmed their workforce and they leaned up a little bit. So now any incremental revenue growth that comes in the next quarter, it's fat margin, right? If you get another 2% of growth on the top line, that's pure margin practically, because you're not going to hire more people. So I think you get some margin expansion. The stock market looks to that for this quarter as, how they're going to achieve success and justify these hugely inflated prices.
We've been on the line with Andrew Zatlin, editor of Moneyball Economics. Andrew, thanks so much for coming on today. Definitely great discussion. Loved having you on. We will talk to you again soon.
You guys rock and roll. Hey, good luck, everybody.
All right, talk to you again soon. Thanks, Andrew. All right, S&P futures just hanging here and trying to stay in a 23.40 handle, down at $1.75. I'm still keeping an eye on yesterday's low, 38 even. That also coincides with mid-range on the day. So if they're going to put the hurt to this market, they got to take it through 37 and change. Coming back on the upside, real stubborn here to get above the close of 42 and a quarter. After that, your guess is as good as mine. I have nothing until your daily pivot of 23.53. Dennis, did you get some trading action in there during that interview with Andrew?
Oh, I was listening to him. He's excellent. So that was a great interview. Loved, the talk there. And, and obviously I do a little bit of trading too on the side there too. And I'll just tell you, this market is tough to figure out here. Obviously, you think, I'm already coming in a little bit biased, and you shouldn't really do that as a trader, but I come in knowing I like my 2-day rule. So I'm looking for follow through on things. But there's buyers in here today. Like it's weird, like usually you'll see, more sellers coming in as we get closer, especially with the sell imbalances that I'm seeing. But I'm seeing a lot of people who are interested in buying this market here too. So, I'm starting to think that maybe we're not going to get a lot of follow through here. We'll have to see what happens when the real liquidity comes in at 9:30 though. That's what we got to wait for, because still, 90% of your institutional players don't trade the pre-market. So the real money is going to come in at 9:30. Let's see what they do here. But as of right now, this market is holding up pretty well, considering I have my 2-day move theory.
And just going back to Tracy C, how do you know if the imbalance to buy for forward is short seller or long positions? You really cannot tell. But just from what I'm seeing this morning, I think it would be more.
Well, Ford has a buy imbalance, so it's buyers.
Yeah,
so you don't have to worry
buyers,
about whether it's short sellers. That question would apply though if you have a sell imbalance. So General Electric 187,000 to sell here this morning, which is interesting because GE is actually looking fairly strong. So I think that might actually flip. But let's use the Bank of America better example, 817,000 to sell. Yeah, it could be any order to sell or sell short. That's below 23.02 will add to that imbalance. So if I put a sell order in there at $23 or a sell short order for 1,000 shares at $23, that sell imbalance will grow by 1,000 shares. That's how it works. So yeah, you don't know whether it's sell or sell short orders that are contributing into that imbalance. I think more than often it's one institutional player that's saying, look, get me the hell out. A lot of times you see just one big, order there. And there are some institutions that trade right on the opening print because they know there's going to be some liquidity there. So, a lot of times when you see just boom, there's big, 400,000 shares to sell off the hop, it's maybe just one player that says, look, I want to sell some stock here right now. But, but when it's a buy imbalance, it's just buyers. Whether they're covering or not, you don't know, though.
All right, Spencer, what's on the docket for Thursday?
We got a couple guests on tomorrow. Phil Davis from Phil Stock World and Scott Redler from T3 Live and the T3 Trading Group. So that's on the docket for Thursday. Hope you enjoyed our show today and our discussions. Hope everyone has a good rest of your day. I'll be in the chat as always. I keep it open throughout the day. If you want to hop into the chat, I will be just kind of hanging out as I am usually. Please remember that all the information and material and content from our show is for informational purposes only and not meant to be investing advice. Have a good rest of your Wednesday, and we'll be back with you folks tomorrow.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.